$20 million for a used Gulfstream? That's cute. In 2026, the real players are dropping $500 million on a Boeing 777X with a walk-in rain shower and a wine cellar. And guess what? They still think they can write the whole thing off and fly to St. Bart's for free. Sounds incredible, right? There's just, one problem. The IRS doesn't agree. And the IRS has more lawyers than you do. Let's start with the claim you see everywhere. Section 179 and bonus depreciation. The idea is simple. You buy a jet and you deduct the entire purchase price from your taxable income in year one. And here's the thing that makes it so appealing. It's partially true. The One Big Beautiful Bill Act, signed in July 2025, permanently restored 100% bonus depreciation for qualifying aircraft. Buy a $20 million jet, place it in service, and on paper, you can deduct all $20 million in that first year. But that's the headline. The fine print is where people lose their shirts. See, first, the jet has to be used more than 50% for business. Not, I think it's business. Not, I checked my email on the tarmac. Actual, documented, IRS defensible business use on more than half of all flight hours. Every single year you own the aircraft. And there's a separate 25% qualified business use test that excludes flights by owners and related parties. If you drop below that 50% threshold in any year during the aircraft's recovery period, the IRS triggers something called depreciation recapture. That $20 million deduction you took in year one. The IRS comes back and says, actually, you owe us the difference between what you deducted and what you would have deducted using boring straight-line depreciation over 6 years. And it gets worse. That recaptured amount isn't taxed as capital gains. It's taxed as ordinary income. So you're paying the highest possible rate on money you thought was free. But forget about recapture for a second. Let's say you sell the jet 5 years later. Any gain up to the amount of depreciation you previously claimed? Ordinary income. Section 1245 recapture. You didn't eliminate the tax. You deferred it. You kicked the can down the runway, and the can got heavier. The IRS launched a dedicated audit campaign in February 2024, opening dozens of investigations into corporate aircraft use. They're not guessing. They obtained detailed internal training materials, and they're requesting flight logs, passenger itineraries, ground transportation receipts, and hotel records for every single flight. So this write off your jet for free idea? It's a deferral at best, and a ticking time bomb at worst. Now, here's where the fantasy really unravels. The idea that checking one email on the tarmac in St. Bart's turns your Caribbean vacation into a business trip. The IRS uses something called the primary purpose test, and it's exactly what it sounds like. The primary purpose of the trip has to be business, not a secondary purpose, not an incidental purpose. The main reason you got on that plane. So you fly to the Bahamas, you take one meeting with a potential client over lunch, and you spend the remaining 4 days on a yacht? The IRS looks at the totality of the trip. How many days were devoted to business versus personal activities? Was the destination chosen for business reasons or, because your wife wanted to go snorkeling in St. Bart's? The IRS isn't stupid. Did you have a pre-existing business relationship with whoever you met? And after the Tax Cuts and Jobs Act, the rules got even tighter. Entertainment expenses are no longer deductible. Period. So even if you did take a client to dinner on that trip, you can't write off the dinner. And the flight expenses attributable to entertainment and personal use? Gone too. The IRS isn't stupid. They see a flight log that shows a Gulfstream landing in Aspen on December 22nd and departing January 3rd, and they know that wasn't a 2-week business conference. You need contemporaneous documentation for every flight. That means a log entry created at the time of the flight, not reconstructed 3 years later when the audit letter arrives. And you know who gets caught the most? Owners of the business. Because under Section 280F, if you're a 5% or greater owner, the rules for what counts as qualified business use are even more restrictive. Flights where the owner is using the jet as compensation or leasing it to themselves through an LLC they control. Those don't count toward the 50% business use threshold. So the people who are most likely to buy a jet and try to write it off are the exact people the tax code watches most carefully. Yeah, Read that again. If you're learning something from this breakdown, subscribe. Next week, we're going deep on another financial myth that's costing people real money. You won't want to miss it. Now we get to the part that almost nobody talks about. Even in the scenario where the company legitimately owns the jet and uses it properly for business, what happens when the CEO takes a personal flight? The IRS says that personal use of a company jet is a taxable fringe benefit. The free flight your company gave you, that's income. It shows up on your W-2. And here's where it gets interesting. The IRS values these flights using something called the Standard Industry Fare Level Formula, or SIFL. It takes the miles of the flight, multiplies them by government-published rates, applies a multiplier based on the aircraft's weight, and adds a terminal charge. For a control employee, which includes officers, directors, and top executives, the multiplier is 400%, 4 times the base calculation. And if you bring your spouse and 2 kids on that free flight from Atlanta to New Jersey, each of them generates a separate SIFL charge. One flight for 4 people on a Gulfstream G650 can create over $2,500 in imputed income, and that's just for one leg. Fly the family to Hawaii and back? You're looking at serious taxable income added to your W-2 that you never actually received as cash. But here's the twist that makes tax attorneys lose sleep. A group of U.S. senators wrote to the Joint Committee on Taxation in November 2025, pointing out that the SIFL formula actually undervalues these flights, in some cases by a factor of 100 or more. Think about that. The SIFL rate for a cross-country flight might produce $3,000 in taxable income, while chartering that same flight would cost $60,000 or more. So right now, executives are actually getting a sweetheart deal on the income they report. But lawmakers are pushing to update the formula. If that happens, the taxable income from personal flights could skyrocket. So what does all of this add up to? There is no free flight. Either the company loses a deduction for entertainment use, or the passenger picks up taxable income, or both. Somebody is paying. The only question is who and how much. This is the part that drives accountants absolutely insane. The fundamental misunderstanding about what a tax write-off actually is. A tax deduction is not a coupon. It's not a rebate. It's not the government handing you free money. A deduction reduces your taxable income. That's it. Let's do the math. You're in the top federal bracket, 37%. You spend $1 on a legitimate business expense. That dollar reduces your taxable income by $1, which saves you 37 cents in federal tax. You still spent 63 cents. On a $20 million jet at a 37% rate, you save $7.4 million in taxes. Sounds great until you realize you're still out $12.6 million. You spent $12.6 million of real money that isn't coming back. Compare that to just not buying the jet. You keep all $20 million. You fly first class for the next 40 years. You still have money left over. Unless the jet generates more than $12.6 million in additional business revenue, you lost money on the deal. This is why accountants grit their teeth when someone says, just write it off. You can write off a lot of things. That doesn't make them free. Nobody buys a $20 million jet to save $7.4 million. That's like, paying full price for dinner just because the restaurant gave you a free breadstick. It doesn't make sense. The jet only makes financial sense if you genuinely need it for business. If flying commercially costs you enough lost deals, wasted time, and missed opportunities to justify the remaining $12.6 million. For some people, it does. For the TikTok crowd buying jets to hack their taxes, it very much does not. So here's the real picture. Depreciation is a deferral, not a deletion. Business use requirements will follow you every year of ownership. Personal flights create taxable income even if no cash changes hands. And a tax write-off still costs you 63 cents on every dollar. Private jets can be legitimate business tools with real tax advantages, but they are not loopholes. They're not free. And the IRS is watching more closely right now than they have in over a decade. If this video saved you from a bad decision, or at least gave you some ammunition for the next dinner party argument, subscribe. We've got more financial myths to tear apart. Click the video on screen right now.